Hi everyone. Welcome to today's webinar brought to you by Vantage. Today is the 24th of February. There is about 20 of you on Zoom and about 200 more than 200 of you in on Vantage app. Okay, so there's more than 200 of you streaming in today. Thank you for taking the time to join our webinar. Thank you for being excited about learning. Thank you for wanting Hi, thank you for wanting to improve as a trader. So, this is the first time in a very long time that I'm doing a topic that is, I would say, technical analysis. So you guys know that every week I'm usually doing like fundamental analysis for you guys, news, geopolitics, macroeconomy, and today's the first time in a long time I'm doing technical analysis for you guys. And I think that because it's been a while and I rarely do this technical analysis um, webinars for you guys, I do hope you guys have questions. You do take this opportunity to ask me whatever questions you want about technical analysis. I am actually a technical analysis specialist. So I love technical analysis. It's just that for the purpose of these webinars, I was requested to do more of the macro and microeconomic topics for you guys. But yeah, today's one of the rare days. Can I ask for email? Yes, you may. Okay, I can give you my email. It's just that I just pull out my email inbox. I have 2,500 unread emails. You can drop me an email. It's just like if I have time, I will see and I reply it. I'm not very on the ball with my email. Okay, let me write it down somewhere. Take note, I'm not very responsive because um on top of my daily duties, I have two toddlers. So any one of you here who have kids will know what I'm talking about. I have two toddlers. They're 1 year old and 2 year old. So they're in the stage where they're constantly climbing things and jumping off things. So during my free time, I don't really have any free time really to look at other stuff. But once in a while I do check my email, and if I see and I can reply you, I will reply you. Okay, so this is my email. Let me know. I'm gonna get rid of it so that I can continue. Okay, everyone good? Welcome. Oh, how do I get rid of this? Oh no, now I'm confused. How do I get rid of it? They're all drawings. Okay, there you go. Okay, yeah, so before we move on, you guys know how this works. I need to go through the disclaimer with you. It's very important that I do this so that you guys know that, especially today, I am not giving you guys any form of financial advice, investment advice, or any form of signal to buy or sell. Why do I say especially today? Because today will be one of the rare days that I will be going to TradingView once I'm done with the slides. So the first part of the webinar, I'm going to explain to you guys why today's topic, which is why price moves in trends, ranges, and breakouts. So we're going to understand the psychology behind it, a little bit of why things are happening. And then later on, I'm going to go into the live charts, and then I'm going to show you how to apply whatever we learned today into the charts. So especially today, we do this disclaimer every single week, but especially today, I want to remind you guys that I'm not giving you any form of signal to buy or sell. Any kind of signal to buy or sell, any kind of investment or financial advice. Okay, this is purely an educational webinar. Please do not yeah, this is purely an educational webinar. Please do not misconstrue anything that I say. Okay, so I'm gonna stay here for a minute or two so you guys can read through the disclaimer. But yes, the whole point is a reminder that you are trading on your own risk. No one is asking you to do something you shouldn't be doing, okay? And a risk warning, trading, Forex, and CFDs, especially on high margin, carries significant risk. and you may lose more than you intend to. Hey, Helen, which part of the Philippines are you from? I used to live in the Philippines. Tacloban City. I have no idea. I have no idea where that is. Okay, I was in Manila and Baguio, so not very familiar about the other place. Oh wait, I was also in Pampanga, Clark, I think is what it's called. So I was there for about a good few months. I was there training with a Filipino coach. Oh, okay. Okay, I now I know. Next time visit Boracay. Oh, I want to. I really want to visit Boracay, but oh my gosh, the kids. You can't go anywhere without the kids. My last holiday with the kids was a nightmare. So, Boracay definitely, but probably in a few years when the kids start kindergarten or something. But yeah, I love Philippines. Brother-in-law is Filipino. Okay, cool. I'm gonna move on to let us know if you have a trading fair. I would love to fly in. Oh, nice. Okay, I will let you guys know. Okay, so for those who don't already know me, my name is Cassandra. I mean, there's gonna obviously gonna be someone who doesn't know me because there's 200 of you, more than 200 of you today. I don't expect all 200 of you to already know me. My name is Cassandra. You guys can call me Cass. I am an investment analyst. I'm based in Singapore. Okay, so I'm with a research firm called Everest Fortune Group. We have been the finalists for the best Forex and best equity research. Our team, we specialize in research, forecasting, back testing, um, basically understanding where the markets are going. Okay, so we spend a lot of time looking at the charts and understanding where it's going. Because of all that time we spend on the markets and on the charts, obviously I would have reached a certain level in trading. I mean, if you spend that much time on something, I would hope you become professional in it, right? So because we spend so much time on the charts, I am also a prop trader. For those who don't know what prop trading means, it means that I'm funded by multiple companies to trade their funds. How did I get this funding? I had to pass their tests. It's a very rigorous, rigid test. I had to do 10% profit within a month. So doing 10% profit for me is not that hard. I've done it multiple times. On a normal month, 6 to 8% for me is a very normal month. Okay, and how do I do that? I use technical analysis, and now I've started combining, actually because of you guys, because of Vantage, because Vantage requested that I do fundamentals, microeconomic. So every time that I'm doing research to do these topics for you guys, I implement that research into my technical analysis, and my trades have become even more high probability. I think the last few weeks I have had a 100% win rate. Okay, I take about uh one to two trades a week, sometimes no trades, but yeah, it's been pretty good so far, especially since I'm combining a lot of fundamental analysis because it's helping me see the markets from a different point of view. That's why I always tell you guys, although I know sometimes you come and join my webinar, it can come off as a bit dry because it's not the exciting technical analysis, right? We have to admit technical analysis is more exciting, but fundamental analysis and microeconomics, geopolitics, all this will help you see the markets in a different point of view, and you will kind of understand why the markets are doing what it's doing. Okay, so our agenda for today is to understand accumulation, expansion, and distribution phases, why trends persist longer than traders expect, false breakouts and liquidity grabs, and matching strategy to market regimes. So, because it's technical analysis, I would be done in about half an hour. I would have a good 20 more minutes to go on the charts and then we can go through the charts together. I'll show you guys how how we can apply today's topic into the charts. Okay, I'm seeing there is so many of you today. right? Usually for Zoom, there's about less than 20 of you, about 20, but today there's more than 20 of you. So a lot of you on Zoom today. Hello, for those who are here for the first time. Okay, so let me move on. Okay. Um, accumulation, expansion, and distribution phase. Okay, let's start with this one. Okay, so when we ask why price moves in trends, ranges, and breakouts, we are really asking how capital flows through markets over time. Price does not move randomly, okay? I can tell you guys this for sure. There's always a reason why price is going a certain direction, okay? It is never ever random. Um, Unfortunately, I don't really teach you guys a lot of technical analysis, but if I taught you a technical analysis, I will show you through different things like the Wyckoff method, mm, Elliott wave, that these people, Mr. Wyckoff and Mr. Elliott, I can't remember their real names, okay, their first names, but these are the analysts or the traders from back then who discovered that, hey, the charts are never random. It's constantly repeating the move over and over and over again, right? It's constantly. Do you guys notice that an economy crash keeps happening every 10 years? Do you notice that price keeps doing a certain thing and then keeps it's never random. It's always a repetition. It's not the exact repeat from the past time, but it's always a similar repetition. Okay, so price does not move randomly. It moves as a reflection of positioning, inventory, transfer, and expectation adjustment. At its core, market structure tends to rotate through three broad phases: accumulation, expansion, and distribution. Okay, so these phases are not mystical. They are logical consequences of a large participants and that enter and exit their positions. Okay, so accumulation typically occurs when the broader market narrative is uncertain or transitioning. Okay, so volatility compresses, price moves sideways within a defined range. During this period, stronger hands gradually build exposure without aggressive moving price. They cannot buy or sell their full size immediately without causing slippage, or so they operate within the range. So it's basically they're just moving sideways. So the range itself becomes a transfer zone. Impatient traders provide liquidity, institutions absorb it. Sentiment is often mixed. News flow may be contradictory, and the environment feels dull and directionless. But beneath the surface, positioning is shifting. Expansion begins when the imbalance between supply and demand becomes large enough that price must reprice to a new level. Once the range boundaries are violated and liquidity is cleared, momentum accelerates. Stops are triggered, breakout traders enter, trend followers increase exposure, volatility expands. This is the phase most retail traders recognize as the trend, okay? But the trend is simply the visible portion of a positioning imbalance that begin during accumulation. So distribution is the mirror of image accumulation. After a sustained trend, early participants begin to reduce exposure. Price may still appear strong, but momentum starts to decelerate. Volatility increases within a range near the highs or lows. Late participants enter aggressively, just as larger players gradually exit. Okay? Risk is transferred from strong to weaker hands. Eventually, when distribution is complete, expansion occurs in the opposite direction. This cycle is fractal. It occurs on intraday charts and multi-year macro cycles. Understanding it reframes price as process of inventory transfer rather than a sequence of isolated candles. Okay, so a trend does not begin because traders collectively decide to buy or sell. It begins because an imbalance has reached a threshold. During accumulation, liquidity builds above range highs and below range lows. Okay, stop loss orders clusters in these areas. When price reaches those levels, it does more than break a line on a chart. It releases stored liquidity. Stop loss cascades occur when positions on the wrong side are forced to exit. If price breaks upwards, short positions are covered. That covering adds buying pressure, and breakout traders adds fresh longs. Okay, so momentum systems detect directional movement and increase exposure. Volatility expands as liquidity thins. The trend becomes self-reinforcing. This is why expansion often appears faster than the preceding range. It reflects both new participation and forced repositioning from a structural perspective. Higher highs and higher lows are not simply technical patterns, they represent repeated evidence that demand overwhelms supply at progressively higher prices. The market rebalances at each pause, but buyers consistently defend pullbacks. What is critical to understand is that trends persist not because of emotions alone, but because of structural positioning. As long as incremental buyers remain and forced sellers are limited, price continues to drift in the direction of imbalance. The expansion phase continues until either supply overwhelms demand again or external information alters expectations significantly. So when that occurs, volatility often increases and the transition towards distribution begins. Okay, so distribution is rarely dramatic at the end. It often begins um, quietly. Okay, this is an example of Wyckoff method actually. So I'm going to explain this in a bit, but let me just explain distribution first. Okay, so after an extended expansion, price may continue making marginal new highs or lows. However, the character of the move changes. Follow through weakens, pullbacks deepen, breakouts fail more frequently. Large participants who accumulated earlier begin reducing exposure. They do so gradually to avoid collapsing price against themselves. Meanwhile, late cycle traders, often encouraged by strong past performance and reinforcing narratives, increase exposure. This creates increased two-way volatility. Price may trade aggressively in both directions within a broad range. The market appears active but lacks directional commitment. Momentum indicators may show divergence and volume patterns may shift. But most importantly, structural behavior changes. Instead of a clean continuation pattern, we observe failed breakouts and rapid reversals. Eventually, once sufficient inventory has transferred and marginal demand weakens, expansion resumes in the opposite direction. The prior trends ends not because of a single candle, but because the imbalance that sustained it has been is exhausted. So recognizing distribution requires patience and contextual thinking. It is not a single signal, it is a transition in character. Okay, so I put a photo here of the Wyckoff method. Why did I put a photo here? Because the Wyckoff method is one that explains trend very well. But obviously today's topic is not purely on the Wyckoff method. Okay. If I had to do a if I need to explain the Wyckoff method in detail, it would take me an hour or more. Okay, but just the very big picture. Okay, basically the Wyckoff method has accumulation, markup, distribution, and markdown. So you can see here, this is the sideways market, and from the Wyckoff method, you will be able to understand what exactly it's doing. So how does the Wyckoff method help you in any way at all? It helps you by understanding. So, okay, before I understood the Wyckoff method, every time when I see the markets going sideways, I always tell myself, okay, let me wait for price to break out, then I can decide where the trend is going. But if you understand the Wyckoff method will tell you where price is going before the breakout even happens. Okay, so again, I cannot really go into too much detail for the Wyckoff method because that's an entire webinar its own. But if you guys want to understand sideways market more in depth, the Wyckoff method, okay, which is WH, how do I spell the Wyckoff method? It's WYCAOFF. Okay. The Wyckoff method explains the sideways market very, very much in detail because people like me, usually when I see markets going sideways, I totally don't trade at all. I immediately stay out of the markets. But if you understand the Wyckoff method, there is actually a way for you to trade. Okay, provided you understand it. Okay, so let's move on to the next part, which is why trends persist longer than traders expect it to. Okay. Okay, so one of the most consistent behavioral errors in trading is underestimating how long a trend can persist. Traders often attempt to call the top or bottom far earlier than structural evidence support. So again, you guys have never seen me trade. Can Vantage offer Wyckoff this quarter? Okay, give me a moment. I can schedule Wyckoff into my next few webinars. It's just that okay, so I take you guys every Tuesday. How about I do one in April? Okay, so let me write that down because I will definitely forget. Uh, Give me a moment. I'm gonna set an alarm. Once this webinar ends, I will schedule the Wyckoff method for next in April. It has to be in April. I'm sorry, I can't do it next month. I can't do it in March because the March webinars have already been scheduled 2 months ago. So we always schedule our topics 2 months in advance. So right now, if I schedule from April, I can still schedule. So once this webinar ends, I'll just have a reminder label. Schedule Wyckoff method or April Vantage. Okay, so I've got a reminder here. My alarm will ring in 40 minutes. Okay, wait, I'll put 50 minutes. My alarm will ring after this and I will remember to go and schedule the Wyckoff method. But again, because Vantage personally requested that I do a lot of like microeconomic. Once in a while, I can do technical analysis for you guys, but let's try not to make it too often. Okay, so where was I? Okay, so if you guys have seen me trade, you know that I'm not someone my style of trading is actually very simple, right? My style of trading is I don't try to catch the top, like I don't try to catch the sell from the highest top, and I don't catch the buy at the lowest low. Okay, my style of trading is so simple. When price is already ranging, I try to catch the buy here. Okay, because you see, the thing is, price is constantly moving in an uptrend, right? If it's moving, sorry, not an uptrend. Price is constantly moving in a zigzag pattern. So whether if it's moving up or if it's moving down, price is moving in a zigzag pattern. Why is it moving in a zigzag pattern? Because price is pulling back. It moves up, it pulls back. It moves up, it pulls back. So I am very good at identifying pullbacks. You don't need to master everything in trading. You just need to be good in one thing, and that one thing is enough to help you be profitable in trading. So for me, my specialty, I would say, is identifying pullback. So once price makes a high, it pulls back. Where is it going to pull back to? Nobody knows. I use technical analysis and I can kind of figure out where it's going to pull back to. And then this is where I enter for a buy. Then I buy it to the next level and I get out. This is my take profit. So all my trading is like that. It's very simple. It's very straightforward. Um, I can try to show it you guys later if we still have time, but yeah. So my whole point of telling you that is that everyone has different trading styles, but the problem is some traders often attempt to call the top and try to call the bottom earlier than structural evidence would support. Okay, so to understand why trends last longer than expected, we must move away from emotional explanations and towards structural mechanism. A trend persists because an imbalance persists. When price trends upwards, it is not because buyers are enthusiastic. It is because incremental demand continues to exceed incremental supply at successive price levels. Each time price pulls back and finds support at a higher high, it confirms that the marginal buyer is still present and willing to transact at increasingly expensive prices. Okay, a very good example to this is gold. I was just looking at gold, the gold chart right before I started the webinar for you guys. Gold is constantly at all-time high. It is constantly at all-time high. If you think it was at the high, the next moment it's in the new high again. Okay, I remember so clearly during COVID that I think it was at 2003, or is it $3,000 XAU USD, and everyone was like, "Oh my God, gold is so expensive. It's so high in price, yada yada." Today, gold is at 5,000. It's constantly making new high. It's because the buyers are constantly willing to buy or transact at that increased price because they see value in gold. That's why microeconomic is so important. If you understand gold, you understand why the prices keep going up, because technical analysis would not been able to tell you that. Only fundamental analysis would have tell you why gold keeps going up, because gold is a safe haven assets, and whenever there's fear, people run to gold. Okay. So this is not a single event, it is a process. Institutional capital relocates gradually. Pension funds, sovereign wealth funds, asset managers, and macro funds do not enter full positions in one day. They scale exposure over time. They rebalance portfolios in response to evolving macro data. They increase exposure as confirmation builds. This gradual positioning creates inertia. Inertia is what sustains trend. As long as structural flows continue in one direction, counter trend moves tend to be temporary. They represent profit taking, short-term liquidity adjustments, or tactical repositioning, but they do not necessarily signal exhaustion. Okay, it could be a very simple pullback. Like I said, price is constantly moving in a zigzag pattern. Another key dimension is anchoring. Market participants anchor to prior price levels. When price exceeds previous highs, when new narratives emerge to justify higher valuation. As those narratives spread, more capital participates. The trend becomes self-reinforcing, not because it is irrational, but because it aligns with shifting expectations. Importantly, trend maturity and trend exhaustions are not the same. A trend can be mature in duration, yet structurally intact. Traders frequently confuse duration with vulnerability, but what matters is not how long a trend has existed. What matters is whether the underlying imbalance is weakening. So when you see price kind of going sideways, you kind of know that price is kind of losing momentum. and there is a possibility of trend reversal because it's like the buyers are taking a break. Okay, so if higher highs continue to be made with shallow retracements and strong follow-through, structural demands remains present. Attempting to fade such conditions purely because the move feels extended is often premature. Trends persist because repositioning across the global capital systems takes time. As long as incremental participants remain and liquidity continues to flow in the direction of the move, this trend can continue far longer than anticipated. Okay, so beyond structural imbalance, psychological bias plays a critical role in why traders underestimate trend persistence. Humans are conditioned to expect mean reversion. Okay, in everyday life, extremes tend to normalize. Temperatures fluctuate, economic data oscillates, social behavior stabilizes. This mental model influences trading behavior. When price accelerates in one direction, traders instinctively assume it must revert because it cannot keep going, right? Sometimes I look at gold and I just keep thinking, you cannot keep going higher, but it just keeps going higher, right? So that's my human flaw that I have limiting beliefs in terms of that. So this assumption ignores the reality that financial markets can sustain this equilibrium far longer than intuition suggests. Another bias is anchoring to perceived fair value. Traders often form a view of what price should be based on prior ranges, valuation metrics, or historical levels. When price exceeds those anchors, it feels mispriced. Yet markets do not move towards fairness. They move towards um, clearing liquidity and reflecting collective positioning. The desire to call the top and bottom is almost psychological. There is intellectual satisfaction in identifying reversal points. However, statistically, reversals are far less common than continuations during established trends. Attempting to predict turning points without structural evidence often leads to repeated losses. Okay, that's why for me, like I said earlier on, my style of trading is that I am a trend trader. Number one, I need to identify trend. And then number two, I am just buying the continuation of that trend. Okay, that is purely my style of trading. I've been trading like this for many, many years, and for many, many years, I have been in profits. Okay, if one day I start losing money, then I will tell you guys, this strategy cannot be used anymore. But as of right now, still works. Okay, so indicator over-reliance compounds this issue as well. Oscillators may show overbought readings for extended periods during strong trends. Traders who interpret overbought as, okay, it's at the overbought price now, it must fall, will misread context because indicators can never be 100% correct all of the time. So in strong trends, overbought conditions often signal strength, not weakness. The deeper issue is misunderstanding flow persistence. When macro conditions support a directional bias, whether through monetary policy divergence, capital rotations, or structural supply constraints, flows can remain consistent for months or even years. So, for example, if a central bank is tightening while others are easing, currency trends can persist far beyond what technical overextension suggests. If global growth is synchronized, equity indices can trend upwards longer than valuation models predict. So behavioral discomfort with extended movement leads traders to fade strength prematurely. Institutional participants, by contrast, often scale into strength and reduce exposure only when structural conditions change. Understanding this behavioral gap help explain why trends persist and why many traders struggles to participate in them. Okay, so the final dimension of trend persistence lies in macro regime context. Trends are often expressions of broader regime shifts rather than isolated technical events. Liquidity cycles play a foundational role when global liquidity expands through quantitative easing, low real rates, or accommodative credit conditions. Risk assets often trend upwards. This trend can persist until liquidity conditions materially change. Conversely, when liquidity contracts, whether through rate hikes or balance sheets reduction, risk assets may trend downwards for extended periods. These macro regimes define the backdrop within which technical patterns operate. Policy divergence is another powerful driver. If one central bank is tightening aggressively while another remains accommodative, currency trends can persist because yield differentials widen steadily. These trends do not reverse until policy trajectory converge. Structural themes also matter. Technological transformation, demographic shifts, energy transitions, and fiscal policy realignment can sustain multi-year trends. These themes channel capital into specific sectors or asset classes, reinforcing directional persistence. Capital rotation between sectors and regions further sustain movement when investors shifts allocation from one geography to another based on growth prospects. The receiving market experiences sustained inflows. These flows do not reverse quickly because asset allocation decisions involve committees, mandates, and institutional frameworks. So this distinguishing between a correction within a regime and a true regime shift is essential. Corrections are pauses within ongoing imbalance. Regime shifts represents a fundamental change in liquidity, policy, or structural narrative. So trends persist longer than traders expect because regimes changes are rare relative to corrections. So markets spend far more time trending within established macro environments than reversing into new ones. Therefore, assessing trend longevity requires stepping back from the chart and evaluating the broader macro framework. Is liquidity supportive? Is policy aligned with directions? Are capital flows consistent? If the answer supports continuation, the trend may remain intact short term despite short term volatility. Okay, so false breakouts. Okay, why false breakouts fail and liquidity before direction? False breakouts are not random accidents. They are structural events rooted in liquidity dynamics. So you guys need to remember that trading is a zero-sum game. That means that if somebody wins in trading, somebody has to lose. So these false breakouts are there to as stop loss grabs because people are constantly putting their stop loss above swing highs, swing lows, above like key support levels. So when you put your stop loss there, the institutional traders are there purposely doing all these false breakouts so that they can take and grab your money whenever you get stopped out. Why? Because if I have to win $10, someone somewhere in the markets need to lose the $10, right? The money doesn't just come out from thin air. I need to be on the winning end and someone has to be in the losing end for someone to make money. Okay, so to understand why the breakouts even fell, we must understand what sits above obvious swings highs and swing lows. These areas contains liquidity. Specifically, they contain stop loss orders and breakout entry orders. So when price consolidates in a range, market participants naturally define the range boundaries as reference points. Traders place protective stops just beyond those levels. Okay, breakout traders place entry orders just beyond those levels. The result is a concentration of resting orders. Liquidity pools form at these obvious structural points. Large participants require liquidity to enter and or exit positions of size. They cannot simply transact within thin order books without causing slippage. Therefore, there is incentive to move price towards areas where liquidity is abundant. Where price breaches a well-defined high, it triggers stop losses from short positions and activates breakouts buy orders. This creates a surge of market orders. For a brief period, price may accelerate, but you need to know that for us retail traders, we are so small in the market. The market is constantly moving trillions of dollars on a daily basis. Okay, on a daily basis, that's mean on a 24 hours basis, it is moving trillions of dollars. Even if you have $1 million account, it is nothing relative to what is happening in the markets on a daily basis. So even if there is a false breakout and all those people's buy orders gets triggered, right? It's only triggered for a short period of time before the big whales or the institutional people come in and sell and push prices down again. And again, this is done on purpose. Okay, so if you understand the Wyckoff method, you'll understand when this happens. The Wyckoff method will help you identify when the false breakout is going to happen, when the institutional traders are going to happen. Basically, the Wyckoff method is a method that follows the movement of institutional traders. Okay, so um, if there is insufficient genuine follow-through demand beyond that level, price can quickly reverse. Like I said, once the liquidity has been absorbed, what happens to be a breakout is in fact a liquidity sweep. So the key distinction between a true breakout and a liquidity grab lies in continuation. A genuine breakout is characterized by sustained participation beyond the breach level. It holds above prior resistance and builds structure. So you will start to see zigzag pattern, higher highs, higher lows forming above that breakout. A false breakout lacks follow through. It returns quickly into the prior range. False breakouts are common because markets are constantly probing for liquidity. They represent the clearing of inventory rather than beginning of structural imbalance. Understanding this shift perspective from frustration to structure, it is not that markets are tricking traders. It is that liquidity must be assessed before sustained movements can occur. Okay, so when a breakout occurs, price often accelerates rapidly. This acceleration is driven by stop loss cascades and momentum ignition. Stop loss cascades happens when protective stops are triggered sequentially. As one layer of stops is hit, markets order execute, pushing price further into the next cluster. The process can be swift and dramatic. Momentum traders and algorithmic detect the acceleration and add exposure in the direction of the move. For a short period, the market appears decisive. However, acceleration alone does not guarantee structural continuation. What matters is whether new participants are willing to transact at higher prices without being forced by stops. In a false breakout, the initial acceleration exhausts available liquidity. Once stops and breakouts orders are absorbed, they may be insufficient fresh demands. Large participants who accumulate liquidity may then reverse directions, pushing price back into the range. The reversal can be equally swift. Traders who entered on a breakout are now trapped. The stop losses often placed back inside the range create additional pressure in the opposite direction. This is why false breakouts often produce sharp emotional charged reversals. They reflect a shift in order flow dominance. So volume analysis can sometimes reveal the difference. A breakout accompanied by a volume spike but lacking structural follow-through suggests liquidity absorptions rather than genuine expansion. Understanding these mechanics reframe false breakouts not as anomalies but as part of natural liquidity clearing process preceding more durable moves. Okay, so the probability of false breakout depends heavily on context. Okay, breakout from a mature range environment behaves differently from a breakout within an established trend. In range-bound conditions, breakouts are statistically less reliable. The market lacks directional commitment. Volatility compressed within boundaries. Liquidity accumulates repeatedly at highs and lows. In such environments, price often oscillates rather than trends. Breakouts from ranges require strong structural catalysts to sustain continuation. Without such catalysts, liquidity sweeps are common. In contrast, during established trends, pullbacks and consolidation patterns often represent pauses rather than equilibriums. Breakouts in the direction of the prevailing trend tend to have higher probability of continuation because they align with existing imbalance. Timeframe alignment is critical. A breakout that appears significant on a lower timeframe may simply represent noise within a higher timeframe range. Conversely, a breakout online across multiple timeframes carries greater structural weight. Okay, so volatility behavior also provides clues. Genuine breakouts are often preceded by volatility compression and followed by sustained expansion. False breakouts frequently lacked in structural volatility transition. Structural confirmation requires more than a single candle. It involves follow-through, acceptance above or below prior boundaries, and the formation of new higher lows or lower highs. Ultimately, false breakouts are most common when traders attempt to impose trend logic onto range conditions. Recognizing the regime reduces conceptuality to liquidity grabs. Market transitions between regimes in transitional phases. False signals increase patience and contextual awareness becomes essential. So we're going to go into a last part and then we're going to go into trading view. We've got about 10 minutes left after I'm done here. It should be enough to kind of explain how we can see how today's topic can be applied. So matching strategy to market regime. Okay, before matching strategy to market behavior, we must first diagnose the regime. Markets do not behave uniformly. They oscillate between trending environment, range-bound phases and unstable transitional periods. Okay, guys, I'm gonna need a minute. I just need to quickly go to the toilet. Just give me 1 minute. Okay, sorry guys. I just really needed to clear my throat. Give me a moment to check if we're still streaming on Vantage. Okay, cool, we are. Okay, so a trending regime is structurally defined by persistent higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. Pullbacks are shallow relative to expansion. Breakout tends to follow through. Momentum persists rather than fading quickly. A range regime is structurally different. Price oscillates between defined boundaries. Breakouts frequently fail. Volatility compresses. Mean reversion dominates directional continuation. Then there is the transitional regime, which is often most challenging. This occurs when the trend begins to lose momentum but has not yet fully transitioned into a stable range. Volatility increases, breakouts fail more often, two-way more movement intensifies. So correct regime identification requires observing behavior, not predicting it. Traders often misclassify ranges as emerging trends or interpret healthy pullbacks as reversals. Okay. Um, Misdiagnosing leads to strategic mismatch. Volatility behavior offers strong tools. In trends, volatility tends to expand in a direction of a move compressed during pullbacks. In ranges, volatility remains relatively symmetrical and confined within boundaries. So momentum persists. Tense is another indicator. In trending markets, momentum oscillators may remain elevated and depressed for extended periods. In ranges, oscillations or oscillator cycles cleanly between extremes. The key insight is that the strategy performance depends heavily on regime alignment. A breakout strategy applied in a mature range will experience repeated false signals. A mean reversion strategy applied in a strong trend will face repeated stop-outs. Therefore, identifying regime is not optional, it is foundational. Okay, so sorry guys. There's haze happening in Singapore, right? Our beloved neighbor forest is on fire, so I think the wind is blowing the haze over, so everyone around me is sick. I'm constantly having something stuck in my throat. So sorry, I had to take a break just now. Okay, so I'm gonna go into trading view. The last part, let me just quickly do the last part and then we can go into trading view. So before matching strategy to market behavior, we must first diagnose the regime. Markets do not behave in uniformly. They oscillate between trending environments. Okay, like I said. So in trending environments, continuation strategies tend to outperform. This includes breakout entries and pullback entries aligned with prevailing directions. The objective is to participate in expansion phases rather than anticipate reversal. So pullbacks within trends often represent liquidity resets rather than structural shifts. Buying higher lows is in an uptrend, or selling lower highs in a downtrend aligns with imbalance rather than fighting it. Okay, so holding periods in trending regimes may extend longer than initially expected. The goal becomes riding structural flow rather than capturing small oscillation. In range environment, mean reversion strategies tend to be more effective. Buying near support and selling near resistance aligns with equilibrium behavior. Breakouts are approached cautiously, often requiring additional confirmation. Risk asymmetry differs significantly between regimes. In trends, risk is often defined by structural swing points. In ranges, risk is defined by boundaries. So applying a mean reversion strategy is a strong trend, exposes the trader to repeated small losses as price continues in one direction. Applying breakout logic in a mature range exposure the trader to false breakout. Okay. So strategic alignment is less about prediction and more about adaptation. The market reveals its character through repeated behavior. The trader's task is to respond, not impose expectations. Okay, so now that we are done, right? This is Vantage's handle. You guys can follow them on social media or whatever you want to follow. In the meantime, I'm gonna pull up TradingView. Okay, let me know if you guys can see TradingView. You should be able to. This is my free random account. Okay, let me just show you EUR/USD. Let me choose Vantage. So if you are trading with Vantage, please, oh my gosh, my throat. Hey, please choose Vantage as the background. Okay, so I'm going to go to the settings. Okay, I don't like I want to clear the scales and the lines. Hold on. It's been a while since I had to do this. Sorry, guys, because I usually trade on a different account. Okay, forget it. Okay, we're just gonna trade on URUSD. I'm gonna get rid of this volume indicator. Got it. Get rid of this volume indicator. Okay, so if we're looking at URUSD, right? You can see, let's first identify trend. Or you know what? Let's go to gold. Let's first identify trends. So can you guys just quickly let me know in the chat box? Hi, Jamilu. Haven't seen you in a while, actually. Jamilu, I don't know if you know that we moved to YouTube on the other place. Not YouTube, Zoom. Okay, so first thing first, let's identify trend. So can you guys let me know in the chat box if price is going up or down or left or right or sideways? Thank you. Price is going um up. It's moving on an upwards trend. So thank you guys. Thanks for identifying, helping me identify. So my style of trading, I am a trend trader. It's very important that I identify trend. So like we were saying just now in on the slides, it's important to identify trend on my time frames because what is happening on the daily may not be showing you the entire picture. So I'll give you a good example of this. A good example of why you have to do multi-time frame is because I'm gonna do Vantage URUSD. So if we're looking on a daily chart for URUSD, it looks like price is going on an uptrend, right? I can literally pull out a channel and I can literally draw an ascending channel. You can see price is moving in a beautiful, clear uptrend, right? But here's the thing. If you don't check on multiple time frames, you might think you're moving on an uptrend, whereas on the weekly time frame, price is actually moving in a downtrend. Do you guys see that? Price is also moving in the channel, but the channel is moving down. That's why it is important to do multi-time frame analysis in terms of trend so that you're not going against the bigger trend. See, price is also moving in a channel. Okay, basically if I adjust this, it can look very nice. Okay, you get my point, right? You get my point that this can be drawn very nicely. Okay, so price is also moving in a very nice channel, but towards the downtrend, right? That's why it's important to check multiple time frames. Because the bigger time frame actually holds more structure. Okay, the bigger time frame actually holds more structure. So on the daily, you're like, okay, it's an uptrend, I'm going in for a buy. But on the weekly, you need to know that you need to be very cautious because price is actually moving in a downtrend, and that downtrend can really, really hurt you if you continue thinking that it's an uptrend, but now you're reaching a resistance on a downtrend. Okay, so first things first, when we're talking about trend, you need to do multi-time frame. Okay, very good question. Someone is asking, so in this case, if price is up on one time frame and down on another time frame, which is the correct time frame? Which is the correct trend? Oh gosh. Okay, very good question. So there's one thing, I cannot tell you which exactly is the correct trend, but I need to tell you one thing to take into consideration. Whenever you are looking at trend, you need to remember the bigger time frames will always hold more value than the smaller time frames. Okay? The bigger time frames will always hold more value than the smaller time frames. Why? Because the bigger time frame is structurally stronger. So an example is if I go to the 1 minute, and you see price going on a downtrend, uptrend on a 1 minute, but on the 1 hour, it's going on a downtrend. I am going to believe the 1 hour. Why? Because the structure on the 1 minute is just not as strong as the structure on the 1 hour, right? The bigger the time frame, the stronger the structure. So if we're taking EUR/USD as an example, on the weekly, it is clearly moving on a nice downtrend, right? What constitutes a downtrend? Higher, lower high, and lower lows. So price is clearly moving in a very beautiful lower highs, lower low kind of situation. It's moving in a very beautiful channel actually, right? So, but on the daily, it's moving up. So which one do I follow? Honestly, for me, I will take the bigger time frame into consideration first. Okay, why? Because again, the bigger time frame is stronger. So in this case, if the bigger time frame is telling is a sell, do I get in for a sell now? Yes or no? If the weekly time frame is telling me to a sell and the daily time frame is telling me it's a buy, do I get into a sell now? Okay, I've got answers coming in. No. Yes, you should get into a sell. Some is saying sell, some is saying buy. Okay, we need to remember one thing. Price is constantly moving in a zigzag pattern. Whether it is, I'm going to go to a blank space so you guys are not confused. Price is constantly moving in a zigzag pattern. Whether it's up or down, it's moving in a zigzag pattern. Okay, so on the weekly, price is moving on a zigzag pattern down. On the daily, it is moving on a zigzag pattern up. But when price is moving on a zigzag pattern on the weekly time frame, it is basically just a pullback, right? That's why, my gosh, what's happening? Hey, sorry guys, let me just log in so I can continue. Obviously, this is not the account I usually trade on. Oh, okay, I'm logged in. Price is moving down on the weekly, but on the daily, it's moving up because it needs to pull back, right? So if it if it's moving in a zigzag pattern, it means that it's pulling back. It means that it's pulling back. That's why when we go down to the daily time frame, it looks like price is moving on an uptrend because on the weekly, it's basically just doing the zigzag pattern of pulling back. Okay, did I explain that part very clearly? Do you understand that part? So on the daily, it looks like it's an uptrend, but actually on the weekly, it's actually just pulling back. Sorry, guys. Okay, I'm glad we're ending the webinar because my throat is giving way. I'm gonna do like 5 more minutes and I'm really gonna have to end it. So yeah, sorry, there's haze in Singapore right now because our neighbor country is burning their forests. Don't know on purpose or by accident, but there's fire happening nearby. Okay. Okay, so to answer the question, do I get in for a buy or do I get in a sell? You need to now go back to the bigger time frame to see if there is room for price to move up to. Okay? You just need to remember that the limit of where the limit of where price should be going to is this blue line. This is as high as price can go. Obviously, the blue line can differ because uh, if I move this trend line a bit higher, it would still be valid, right? If I move it higher, it would still be valid. So technically on the daily time frame, there's still a bit of space for price to move up. So the question is, do I get in now for a sell or is there still a bit of room for price to move up before the sell starts to happen? I think now you need to understand the structure of price. So if we are looking at every time price reaches as high, you can see it reaches the high here. It tends to hover for a bit before it drops, right? It reaches a high here, it drops, and then it comes back and retests another time, and then it drops again, right? So it's not a very clean, perfect move. So this right now you can see price has reached the high. The question now is this really the high or could it go a little bit higher before it drops? I know it's very like, it looks like a very small move, but you need to remember for price to one candle on the weekly time frame is seven candles on the daily time frame. One candle on the weekly time frame equals to seven candles on the daily time frame. So if one candle on the weekly moves up, which would still respect this descending trend line, on the daily, it needs to move seven candles, right? So this candle can move one, two, three, four, five, six, seven, and it can still continue moving in an uptrend, and your trade would still, even though the overall bias is an up, is a down on the weekly, price can right now still move up because of the time frame and because of how many candle it takes for price to make one weekly candle. Okay, so right now, when I see things like this, it makes me very not very confident to trade EUR USD. Why? Because you're kind of like, wait, has it reached the highest high or is there a little bit more for the high, right? Like I said, I am not someone who tries to aim for the high. That is a very risky thing to do. Do not try to aim for the high. Because if you're trying to aim for high, you're basically trying to aim for, you're basically trying to predict when price has reached the top of this trend line and when it's time for a reversal. Because technically, if it's respecting this trend line, it should do this, right? It should reach a high and then now it should reverse, right? So you're trying to predict that, which is very, very risky. There is no need to do that. There's no need to do that. Instead, what you should be doing is, there's really no need to do that. What you should be doing is you should be going into a chart where everything is aligning. So if I go to the weekly on gold, price is going up. If I go on the daily on gold, price is going up. If I go on the 5 hours on gold, price is going up. If I go on any time frame on gold, price is going up. So isn't this a better chart to trade on versus on EUR USD, where on EUR USD you're a little confused. Is price gonna go up a little bit more, or is this the high? Is it time to reverse? You don't know, you don't want to predict. It's very risky to try to predict the high. There is no trader, okay, there's probably a handful of traders in the world, but it is very hard to catch the highest high, and it's very hard to catch the lowest bottom. Instead, it's easier to go and find a chart where the trend is very clear, like gold, for example. It's very clear that gold is moving in an uptrend. One look and everyone can see that gold is moving in an uptrend. No matter what time frame you go in, gold is moving in an uptrend. Therefore, I can confidently say it's a no-brainer to enter gold for a buy, right? Because every time frame is showing you that it's a buy. Okay, so in this case, it's going to be very easy for me to come up with a buy analysis for gold. Okay, I'm just going to quickly show you guys how I would usually come up with a buy analysis. Okay, so I'll draw a trend line, draw where the next zone could possibly be. Give me a moment, guys. I'm basically combining multiple technical analysis into my setup to find a high probability entry I'm gonna do this very fast and I'm not gonna explain what I'm doing, right? Okay, because I don't really have time anymore. I've overshot my time, so I need to do this very quickly. Okay, I already see confluence happening. Okay, so if I have to come up with something, I think there's a good chance gold is gonna pull back to this area here, if it even pulls back. Okay. I think gold is gonna pull back. There's a possibility of gold pulling back to this area, and this area is where my possible buy entry is going to be. Obviously, this is just an example, okay? Please do not follow me blindly. Okay, this is just an example how I would usually do my analysis. It's not accurate because I literally did that in 1 minute. Okay. I literally did that in 1 minute. If I were to really put a bit of time into this, it would take me about 10 minutes to do a single analysis. About 5 to 10 minutes to come up with a proper analysis. This was just me randomly coming up with an analysis. So this could may as well be very wrong. Okay, give me a moment. Okay, yeah. Basically, my point is to don't follow this. Okay, do not copy this. This may not work. Okay. My point is to go into the charts and find a pair that makes sense to do the analysis on, right? Because if you guys think about it, right? If I got an EUR/USD and different time frames telling me different things, I'm just gonna confuse myself. So why don't I go look for a chart where everything is aligning? There's confluence on all time frames, there's confluence on everything, right? So in this example, go Forex. There's so many things to trade. GBP USD, EUR/USD, USD JPY, EUR, AUD USD, NZD USD. There's so many things to try, right? So many things to try. So why don't you just go on the charts where all the trend is clear in every direction? You don't need to force analysis on something that's not going to work. Okay, so that's all I have for you guys today. If you guys learned something from me, I will schedule the Wyckoff methods in April's webinar. Okay, so I'll see you guys then. Okay, take care. Bye.